What's up, everyone? Welcome to the Daily Macro Update for Tuesday, October 14th. We are live currently for Powell's Economic Outlook at I think it's some conference in Philadelphia. We have this live pulled up. It's supposed to start momentarily here. Let me just test this audio to see if you guys can see it. Let me change my screen here. Let me know if you guys can hear this. Put a 1 in the chat.
First, Wilco, who could not be with us today. He's of Amazon, and his impact on NABE has been tremendous. He's been a key driver of the Tech Economics
Let me know if you guys can hear that.
helping it evolve as we've incorporated causal inference and AI tools into our collective toolkit. His vision and technical...
Sweet. Cool. All right, so that's going to start here momentarily. Jerome Powell is set to come on in about 10 minutes at 12:20 p.m. Eastern time. And so we'll go ahead and pan to that. But first, I just want to quickly go over a little bit of the market that we're seeing today. The government shutdown is still going on. I believe this is the 10th trading day. And so when we take a look at the economic data, obviously we're not getting the key government data that we'd be expecting. We're still getting private data though. And so if we take a look at the NFIB Small Business Optimism Index, we can see that this had a pretty large decline from August to September. This is the largest decline in 3 months. And it's mostly due to inflation fears with a lot of small businesses. And so, a lot of the optimism around rates coming down has started to fade a little bit. And so a lot of these small businesses are starting to realize like, hey, inflation is actually still biting us. And so that's definitely a development to keep in mind here, especially if this starts to trend down. That's something that you want to pay attention to, because the last time this really started to decelerate was February through March and April, right when the stock market took a huge dip. And so this indicator right here, very important, would highly recommend that you guys pay attention to it. Inflation expectations still have CPI around 3% from now to October, which gets reported in November. Interestingly, core PCE, which is the Fed's preferred inflation gauge, that's actually starting to top out a little bit and could be coming down. And so there are some indicators that are suggesting that inflation could come down, but it's in the context of slowing growth as well. So, typically when you have slowing growth and inflation happening at the same time, that's more of a recessionary or at least an economic slowdown signal. So we want to be paying attention to that alongside the dollar going bullish. And so when taking a look at the market here, interesting seeing Bitcoin continuing to have a little bit of a dip here. Let me take off the ranges. Let me take off some of these indicators real quick. Yeah, Bitcoin, it's neutral in our model here. Really the only cryptocurrency in the top 10 that remains bullish is BNB, surprisingly, but everything else is pretty much in a bearish trend. I know that Zcash as well is also one of the cryptos that remains in bullish trend. But other than that, everything else bearish, and Bitcoin just remains neutral trend. So in our model, when something is neutral trend, we just want to wait and watch just to see what it does from here. Taking a look at some of the bigger macro developments, as I mentioned before, the dollar has been in a bullish trend for the first time since the end of July, which is the big macro shift that's currently happening right now, right? Because the narrative so far has been a dollar debasement, but over the past several weeks, the dollar has been strengthening quite a bit. And at the timing of this video, it is continuing to push up towards the top end of the trading range there. So, I mean, if you were buying the dollar with some type of dollar-based ETF like this one here, which the ticker is UUP, I wouldn't be buying it right here. This is essentially a point where you can look for dip buying opportunities, which our team and I was doing earlier today. This morning, the markets opened up in the red, and so you had a chance to find some opportunities that are at the low end of the trading range that are in bullish trend. There was some of those there. Mainly one that I've been buying up a little bit has been Apple. So this had a decent deceleration here in price, close to the low end of the trading range. Volume continues to drop off, so that's kind of what we want to see there. So I was buying a little bit of that as well as others. But taking a look at the S&P 500, having a little bit of a pop here, still remains in bullish trend. So if you guys notice the background of the bookshelf, it went from neutral to bullish over the past couple of days, and so we are not bearish on the market, and we're also not neutral. We're actually bullish still. So that's definitely interesting. We see that this cycle that the market's currently in could continue, and so yeah, I mean, if you were able to get in a short here, hopefully you covered right away because this is having a pretty aggressive rebound here. In terms of the Mag 7 stocks, really the biggest opportunity that I'm seeing is in NVIDIA. Not quite to the low end of the trading range just yet, but this does remain in a bullish trend. And so, there was a slight buying opportunity earlier this morning, but NVIDIA is one that is an interesting opportunity there. And then, yeah, we're just seeing a reversal in a lot of the major tech plays. And yeah, it looks like the biggest rebounds have been in some of the things that have gone down a lot and broken trend, like industrials, financials, XLU new highs. Take a look at that. Utilities continue higher, but yeah. So if there's anything that you're holding, we've been saying that this is a good time to consolidate a lot of those positions that may have broken trend. So just checking in and seeing if they're started yet. No, we still got about 5 more minutes until Powell comes on. I believe he is going to be talking about, kind of the Fed's outlook here heading into not the last Fed meeting, but the second to last Fed meeting I believe it's on the 29th, right? And so if we take a look at the Fed fund futures right now, they have currently nearly a 97% chance that they're going to cut by 25 basis points. It's probably what they're going to do because, again, they're very obsessed with the labor market, not necessarily declaring that the structural changes on the supply side are just what they are, is structural changes. And the Fed is going to continue trying to lower rates and use their demand tools with the government to try and fix this supply problem, which you can't fix supply issues with lowering interest rates, right? So we'll see what happens with that there. That's pretty much all I'm seeing here. Just to reiterate, though, we are having from now until the end of the year our 6-week Macro Mastery Challenge, which is where you get full access to our partnership circle, where you have all of our indicators. So the ones that you see here on TradingView, like our trading ranges, you get a full license to that. You get to see all of our positions, all the different updates that we have every single day, so that you can time the market better. And so that, as well as you get to learn our exact macro strategy, you get to learn the macro language that we talk about every single day. It's all included in there. 6-week challenge to get started. Just book a call on the calendar here. My calendar is open, although we've had at least like 10 people book. So spots are running out quick. I would recommend you guys hop on that if you guys are interested in leveling up and adding the macro tools to your investing process, whether that you're just focusing on fundamentals or maybe you are only focusing on technicals and you want to add macro to your arsenal of tools. It's very important to do that here in this post-pandemic environment. So we have that 6-week challenge. Just click on the link below. For those who are on YouTube, for those who are on X, go on my profile bio, and then same with people who are on Instagram and TikTok there. So that link is right there. Let's check in. All right, looks like Powell's on. Let's go ahead and start this.
It for me is an unexpected honor. Just I'll say on a more personal note, I have greatly enjoyed
Can you guys hear
my
this?
regular visits to your annual meeting and your conferences.
Put a 1 in the chat if you
It's
can
really
hear
been
this.
my favorite venue all these years. It's a place. This is a place where we can talk about economic issues and
gonna
not
pass
worry
out.
that someone's eyes might glaze over. I also appreciate the warm welcome I've always received here. And putting
Audio
Fed
kind of
staff
sucks.
aside for a minute, I can't think of a more lovable group of econ nerds anywhere.
Did he just say nerds?
So thank you again for this prestigious award. And for the opportunity to speak to you
It's
here
like a
today.
reward.
So, as we all know, monetary policy is more effective when the public understands what the Federal Reserve does and why. With that in mind, I hope to enhance understanding of one of the more arcane and technical aspects of monetary policy, the Federal Reserve's balance sheet. A colleague recently compared this topic to a trip to the dentist, but I found that comparison somewhat unfair to dentists.
Is this guy making
So
jokes?
today I'll discuss the essential role that our balance sheet played during the pandemic, along with some lessons learned. I'll then review our ample reserves implementation framework and the progress we've made toward normalizing the size
My
of
neighbor
our
is
balance
deciding
sheet.
to do
And I'll
lawn
conclude
care
with some
right
brief
now.
remarks on the economic outlook. So, one of the primary purposes of a central bank is to provide the monetary foundation for the financial system and the broader economy. This foundation is made of central bank liabilities. On the Fed's balance sheet, the liability side of the ledger totaled $6.5 trillion for roughly 95% of the total. First, Federal Reserve notes,
Let me know if
that
you guys
is
can
physical
still hear
currency,
that
totaled
with my
2.4
headphones on.
trillion. Second, reserves, funds held by depository institutions at Federal Reserve banks, totaled 3 trillion. These deposits allow commercial banks to make and receive payments and meet regulatory requirements. Reserves are the safest and most liquid asset in the financial system, and only the Fed can create them. The adequate provision of reserves is only do so by purchasing treasury securities in the open market and crediting the reserve accounts of the banks involved in the transaction with the seller. This process effectively transforms securities held by the public into reserves, but does not change the total amount of government liabilities held by the public. So,
How's
the Fed's
that? Can you
balance
hear
sheet
that?
serves as a critical policy tool, especially when the policy rate is constrained by the effective lower bound, or ELB. When COVID-19 struck in March 2020, the economy came to a near standstill and financial markets seized up, threatening to transform a public health crisis into a severe, prolonged economic downturn. In response, we established a number of emergency liquidity facilities. Those programs, supported at the time by Congress and the administration, provided critical support to markets and were remarkably effective in restoring confidence and stability. At their peak in July 2020, loans from these facilities totaled just over $200 billion.
He's giving a
Most of
recap
these
of
loans
the
with
08
conditions
crisis.
stabilized. That's normally the deepest and most liquid market in the world, and the bedrock of the global financial system was under extraordinary pressure and on the verge of collapse. We used large-scale purchases of securities to restore functionality to the Treasury market. Faced with unprecedented market dysfunction, the Fed purchased Treasury and agency securities at an extraordinary pace in March and April of 2020. These purchases supported the flow of credit to households and businesses and fostered more accommodative financial conditions to support the recovery of the economy when it ultimately came. This source of policy accommodation was particularly important as we had already lowered the federal funds rate close to zero and expected that it would remain there for some time. By June 2020, we slowed our purchase pace to a still substantial $120 billion per month. And in December of 2020, as the economic outlook remained highly uncertain, the FOMC said that we expected to maintain that pace of purchases until substantial further progress has been made toward the committee's maximum employment and price stability goals. That guidance provided assurance that the Fed would not prematurely withdraw support while the economic recovery remained fragile amid unprecedented conditions. And we maintained that pace of asset purchases through October 2021. By then, it had become apparent that elevated inflation was not likely to go away without a strong monetary response. At our meeting in November 2021, announced a phase out of our purchases. And at our next meeting in December, we doubled the pace of that taper and said that asset purchases would conclude by mid-March of 2022. Over the entire period of purchases, our securities holdings increased by $4.6 trillion. So a number of observers have raised questions, fairly enough, about the size and composition of asset purchases during the pandemic recovery. Throughout 2020 and 21, the economy continued to face significant challenges as successive waves of COVID caused widespread disruption and loss. During that tumultuous period, we continued to purchase in order to avoid a sharp, unwelcome tightening of financial conditions at a time when the economy still appeared to be highly vulnerable.
He's just giving a recount of what they did.
Our thinking was,
doing that.
Was informed by recent episodes in which signals about reducing the balance sheet had triggered significant tightening in financial conditions. And we were thinking of the events of December 2018, as well as the 2013 taper tantrum. Regarding the composition of our purchases, some have questioned the inclusion of agency MBS purchases given the strong housing market during the pandemic recovery. Outside of purchases aimed specifically at market functioning, MBS purchases are primarily intended, like our purchases of Treasury securities, to ease broader financial conditions when the policy rate is constrained by the effective lower bound. The extent to which these MBS purchases disproportionately affected housing market conditions during that period is challenging to determine. Many factors affect the mortgage market, and many factors beyond the mortgage market affect supply and demand in the broader housing market. With the clarity of hindsight, we could have and perhaps should have stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks. We knew that we could unwind purchases relatively quickly once we ended them, which is exactly what we did. Research and experience tell us that asset purchases affect the economy through expectations regarding the future size and duration of our balance sheet, so that when we announced our taper, market participants began pricing in its effects, pulling forward the tightening in financial conditions. Stopping sooner could have made some difference, but not likely enough to fundamentally alter the trajectory of the economy. Nonetheless, our experience since 2020 does suggest that we can be more nimble in our use of the balance sheet and more confident that our communications will foster appropriate expectations among market participants, given their growing experience with these tools. Some have also argued that we could have better explained the purpose of asset purchases in real time. There's always room for improved communication, but I believe our statements were reasonably clear about our objectives, which were to support and then sustain smooth market functioning and to help foster accommodative financial conditions.
Yapper over here.
Over time, the relative importance of those objectives evolved with economic conditions, but the objectives were never in conflict. So at the time, this issue appeared to be a distinction without much of a difference. That's not always the case, of course. For example, the March 2023 banking stress led to a sizable increase in our balance sheet through lending operations. We clearly differentiated these financial stability operations from our monetary policy stance. Indeed, we continued to raise the policy rate through that time. Turning to my second topic, our ample reserves regime has proven highly effective, delivering good control of our policy rate across a wide range of challenging economic conditions while promoting financial stability and supporting a resilient payment system. In this framework, an ample supply of reserves ensures adequate liquidity in the banking system, and control of our policy rate is achieved through the setting of our administered rates, interest on reserve balances, and the overnight repurchase rate.
Here's the RRP.
Reverse repo rate, rather. This approach allows us to maintain rate control independently of the size of our balance sheet.
The RRP is only at $4
given
billion
large,
now.
unpredictable swings in liquidity demand from the private sector and significant fluctuations in the autonomous factors affecting reserve supply, such as the TGA. This framework has proved resilient whether the balance sheet is shrinking or growing. Since June 2022, we've reduced the size of our balance sheet by $2.2 trillion, from 35% to just under 22% of GDP, while maintaining effective interest rate control. Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserves conditions. We may approach that point in coming months, and we are closely monitoring a wide range of indicators to inform this decision. Some signs have begun to emerge that liquidity conditions are gradually tightening, including a general firming of repo rates, along with more noticeable but temporary pressures on selected dates. The committee's plans lay out a deliberately cautious approach to avoid the kind of money market strains experienced in September 2019. Moreover, the tools of our implementation framework, including the standing repo facility and the discount window, will help contain funding pressures and keep the federal funds rate within our target range through this transition to lower reserve levels. Normalizing the size of our balance sheet does not mean going back to the balance sheet we had before the pandemic. In the longer run, the size of our balance sheet is determined by the public's demand for our liabilities,
This is net central bank
rather than
liquidity
by
in
our
red versus Bitcoin in
pandemic-related
blue.
asset purchases. Non-reserve liabilities currently stand about $1.1 trillion higher than just prior to the pandemic, thus requiring that our securities holdings be equally higher. Demand for reserves has risen as well, in part reflecting the growth of the banking system and the overall economy. Regarding the composition of our securities portfolio, relative to the outstanding universe of Treasury securities, our portfolio is currently overweight longer-term securities and underweight shorter-term securities. The longer-run composition will be a topic of committee discussion. Transition to our desired composition will occur gradually and predictably, giving market participants time to adjust and
Trade with Mello.
minimizing the
Appreciate
risk
the follow.
of market disruption. Consistent with our longstanding guidance, we aim for a portfolio consisting primarily of Treasury securities over the longer run. Some have questioned whether the interest we pay on reserves is costly to taxpayers. In fact, that is not the case. The Fed earns interest income from Treasury securities that back reserves. Most of the time, our interest earnings from Treasury holdings more than cover the interest paid on reserves, generating significant remittances to the Treasury. By law, we remit all profits to the Treasury after covering expenses. And since 2008, even after accounting for the recent period of negative net income, our total remittances to Treasury have totaled more than $900 billion. While our net interest income has temporarily been negative due to the rapid rise in policy rates to control inflation, this is highly unusual. Our net income will soon turn positive again, as it typically has been throughout our history. Of course, having negative net income has no bearing at all on our ability to conduct monetary policy or meet our financial obligations. If our ability to pay interest on reserves and other liabilities were eliminated, the Fed would lose control over rates. The stance of monetary policy would no longer be appropriately calibrated to economic conditions and would push the economy away from our employment and price stability goals. To restore rate control, large sales of securities over a short period of time would be needed to shrink our balance sheet and the quantity of reserves in the system. The volume and speed of these sales could strain Treasury market functioning and compromise financial stability. Market participants would need to absorb the sales of Treasury securities and agency MBS, which would put upward pressure on the entire yield curve, raising borrowing costs for the Treasury and private sector. Even after that volatile and disruptive process, the banking system would be less resilient and more vulnerable to liquidity shocks. The bottom line is that our ample reserves regime has proven remarkably effective for implementing monetary policy and supporting economic and financial stability.
Yeah, because you're letting the government
So I will
money
close
by issuing
with a brief discussion of the
debt.
economy and the outlook for monetary policy. Although some important government data have been delayed due to the shutdown, we routinely review a wide variety of public and private sector data that have remained available. We also maintain a nationwide network of contacts through the reserve banks who provide valuable insights, which will be summarized in tomorrow's Beige Book. Based on the data we do have, it's fair to say that the outlook for employment and inflation does not appear to have changed much since our September meeting 4 weeks ago. Data available prior to the shutdown, however, show that growth in economic activity may be on a somewhat firmer trajectory than expected. While the unemployment rate remained low through August, payroll gains have slowed sharply, likely in part due to a decline in labor force growth due to lower immigration and lower labor force participation.
Yep.
In this
Like
less
we talked
dynamic
about
and somewhat
yesterday.
softer labor market, the downside risks to employment appear to have risen. While official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue their downward trajectories. Meanwhile, 12-month core PCE inflation was 2.9% in August, up slightly from earlier this year, as rising core goods inflation has outpaced continued disinflation in housing services. Available data and surveys continue to show that goods price increases primarily reflect tariffs rather than broader inflationary pressures. Consistent with these effects, near-term inflation expectations have generally increased this year, while most longer-term expectation measures remain aligned with our 2% goal. Rising downside risks to employment have shifted our assessment of the balance of risks. As a result, we judged it appropriate to take another step toward a more neutral policy stance at our September meeting. There is no risk-free path for policy as we navigate the tension between our employment and inflation goals. This challenge was evident in the dispersion of committee participants' projections at the
He's
September
basically
meeting.
confirming they're going to
And I'll
continue
stress
rate
again that
cuts,
these projections should be
despite
understood
acknowledging
as
the
representing a range of
supply
potential
shortage in
outcomes
the workforce.
whose probabilities evolve as new information informs our meeting-by-meeting approach to policymaking. We'll set policy based on the evolution of the economic outlook and the balance of risks rather than following a predetermined path. And with that, thank you again for this wonderful award and for inviting me here today. I look forward to our discussion. Thank you.
Yeah, so essentially saying no real changes.
No, buddy.
Can you guys hear me
Powell,
now?
for the excellent remarks in the Adam Smith address, and we will have about half an hour for questions.
That was
So
like a long
should have
time.
talked longer. So let me start with, before I go to some of the questions coming in from the audience, and do use the Connect app to generate those. You have said, and you repeated again here, that there are no risk-free paths for the Fed now. So in light of that, and in particular, with where the recent inflation data are running, let me group this with some of the questions that we're seeing coming in on the app as well. Obviously, always data dependent. But thinking about the dual mandate of maximum employment and price stability, how concerned are you that if pass-through of
Can you hear me
tariffs
better
is
now?
slower,
Test.
that might begin to look like more persistent inflation as opposed to a one-time, as if the tariff adjustment came through all at once, and then it would be quite clearly a one-time price level shift?
So that's certainly a risk. As I mentioned, there really isn't a risk-free path now since it appears that inflation is running above our target and appears to be continuing to increase quite gradually, but increase. It's still on the way up. So there's a risk there that would lend to greater persistence. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So those two states of affairs for our two goal variables call for different monetary policy responses. So as they come more into balance, I think the idea has been that policy should move from being tight to some degree to being more neutral as those two things balance out. But it is clear, though, that if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. If we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that, which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
Let's move
Right,
to
but
the
the
other risk
softening is
then and
structural
talk about
changes,
employment a little bit.
not demand.
We had Anna Paulson here yesterday, and she spoke about the break-even unemployment or break-even employment growth rate. And that's a question from the audience as well. So I believe she said that it's certainly lower than it was, and the standard error around those estimates probably
We
includes
looked at
some
that
numbers
chart
that might
yesterday.
even
If
be
you watched
negative.
yesterday's video,
Where do you see the monthly break-even employment growth rate at this point?
I'm not going to try to give you a pinpoint number, but as you pointed out, the standard error around these things is, 50,000 plus or minus, something like that. And, that would certainly, I think the range of plausible numbers for the break-even rate is probably does go below zero, accounting for those standard errors. It's clearly come down a great deal. And that's what's so challenging about this is that both supply and demand in the labor market have come down so sharply, so quickly. And the fact that the unemployment rate has barely moved is kind of remarkable in and of itself, and suggests that they're moving at roughly the same pace. Although, of course, the unemployment rate has ticked up, which suggests that demand is moving a little faster than supply. I wouldn't want to point to a specific number other than to say that it's come way down. And there are many, many estimates out there. By the way, there are many ways to calculate it, so you're going to get different estimates.
We're certainly in a volatile and changing environment. So one question I have is whether you see any changes in the transmission mechanism of monetary policy actions. So when we speak of long and variable lags, as we do, are those changing? And in particular, do you think there might be any difference in the impacts of policy on inflation versus employment? Is one changing more than the other?
That's like 2 or 3 questions, so I might have to come back to you. That's right. So on transmission, there, in theory at least, I see 2 things. One is, what we say and what the actions that we take on monetary policy and how quickly that gets into financial markets. So if you go back to when I was in college, that part would have taken, weeks, months probably. And now that part happens essentially instantaneously. But the rest of it, once it's in the financial markets, how quickly does it affect economic activity, unemployment, employment, inflation, et cetera? I think that's more dependent on the conditions in the economy. For example, if you take the group of people who had extremely low rate mortgages, right? And even so, if you can cut rates, but they're a long way down, and they're sort of in a place where it's going to be expensive to take out a much higher rate mortgage, even assuming significant numbers of cuts. So that has probably blunted the transmission of lower rates into that part of the economy. But overall, I think it still works the way we think it works, which is, long and variable lags means a lot of uncertainty about how it's being affected. I think the last part of your question, the lore has been that inflation and employment come later. The first decisions are purchasing decisions, hiring decisions, and things. Well, purchasing decisions, can be affected probably more quickly. But then those would eventually affect employment and inflation. So longer lags are when the research generally shows longer and longer lags for employment and inflation.
And I guess the variable part of that comment does give us a bit of cover.
A lot of uncertainty.
So you spoke about the adjustments or the challenges that you're facing with some government data not currently being published. Beyond the headline unemployment rate, which we're not going to see right away, what other labor market indicators are you monitoring most closely to gauge that side of the mandate?
So I think everyone's looking at the same non-government data. So there's a set of non-government data around, or non-federal government data around labor markets. For example, state level unemployment, claim reports. You can add those up and get a pretty decent estimate, and that's a really good one. There's also ADP has its data and employment. So in the employment space, there's some plausible data. I will say generally the private data, the alternative data that we look at is better used as a supplement
Market
for the
continues its rebound.
underlying governmental data, which is the gold standard. And it's not as, it won't be as effective as the main course as it would have been as a supplement. So we don't expect that we'd be able to replace
Crypto
the
is still
data we're
being
not
sluggish.
so I think in
Gold
job, in employment
continues
space, there's some
doing what
pretty
it's
good
doing.
substitutes, less so in inflation space, and in economic activity space. And also they're just, they're different private data providers use different universes and different levels of rigor in their data analysis. So we're looking at lots of things, and we're going to make our decisions according to the FOMC schedule. But I think it will be a lot better once we start getting, for example, the September employment report is going to be a very important report, and we're not on track to have that. There would still be time for us to get that. We will get, of course, the September inflation, the CPI and PPI reports. So that's a positive. But we don't comment on fiscal matters, but from our standpoint, we'll start to miss that data, and particularly the October data. If this goes on for a while, they won't be collecting it, and it could become more challenging.
You used the term gold standard, and you didn't mean it in this context, but I'm going to pivot here because there's a question from the audience that's getting a lot of upvotes. So one of your predecessors, Alan Greenspan, used to view the price of gold as an indicator of inflation risk. So in that context, how do you view the rally that we've seen in gold? And if you want to throw in Bitcoin, you can comment on that too.
I'm not going to comment on any particular asset price, including that one. And I think we think of inflation as driven by fundamental supply and demand factors, and it's not something we look at actively.
Fair.
Wow.
The September projections, we saw revised
what you're doing is causing the
GDP
price
growth
of gold to rally.
projections revised upward for both 2025 and 2026. Now, sometimes it's just an issue to issue thing, but how do you reconcile that projection of stronger growth with what we're seeing in terms of a likely weakening labor market?
So even subsequent to the September SEP, we've seen economic activity data which are surprising to the upside. And as I mentioned in my remarks, so you do have a bit of a tension there between the labor market data that we see, very low levels of job creation, and yet people are spending. So economic activity is strong, and it's we're going to have to see how that plays out. Right now, of course, we're not getting any new government data on that, any new federal government data on that.
The reason why he's struggling here, ladies and gentlemen,
of course, if economic activity were stronger, then that would tend to support labor market activities and hiring.
Test.
So we'll have to see how that works out.
Great. Another topic that has permeated the conference over the last 2 days has been AI. So as the Federal Reserve, like all of us, grapple with the implications of generative AI, what plans are in place to assess its long-term impact on productivity, implications for labor markets, and overall economic stability? And does that present any new risks to monetary policy or financial stability?
So you're right. We're doing what other people are doing, which is reading all the things that, so many researchers are working on AI now. It's just amazing. And so we follow all of that. We also have people at the Fed who are doing lots and lots of research on AI. And, in terms of, it's just such early days to be looking for the kind of things that will happen. So, the question of productivity, it was Robert Solow who said that technology is showing up everywhere, but in the productivity data. So this could be the same kind of thing where it's there, but it takes a long time kind of to show itself. Because
let me just pause it here, or not necessarily pause it, but mute it. But what I was trying to say was, and if you guys can hear me, the reason why Powell is struggling with this is because he sees that it's stagflationary conditions, and when the market is stagflationary, this is the absolute worst position that the Fed wants to be in, right? So he won't comment on Bitcoin going up. He won't comment on gold going up because he knows that he doesn't want the stagflation conversation to come back into play, right? But this is not a great spot for him. He looks pretty pissed.
This area with AI and either, sort of freeze hiring where it is or reduce hiring. And, I think we're pretty aware of what the potential outcomes are, but the range of potential outcomes is very broad. I will say, in terms of what the Fed can do, we deal with supply and demand. We have an interest rate and we also do regulation, that kind of thing. But if what's needed is greater education and skills, I mean, I've always liked the model that, technology can work for everybody as long as everybody's getting the skills and aptitudes they need to use that technology. This is Golden and Katz, their work, which they actually spoke about at Jackson Hole this year, but it's a 20-year-old book that they wrote. So we can't do that. That's not something the Fed can do. We also can't address the potential societal disruptions that could happen, potentially, if there's really significant job loss. So there are a lot of, we're the least of it. There are potentially really significant implications for people in the labor force. And I think we're all speculating about what those might be, but it's only the beginning of this story.
Yeah. Looking at some of the other questions that are getting upvoted, and you can get as far into the weeds as you want, but this is where people want to go. So let me try this one. As you think of the appropriate level of reserves in the system, what indicators are most important? Is it the price of money, so repo levels, or the volume of borrowings from the Fed, like the discount window, and so on?
So we have a nice spider chart and 5 main indicators, one of which is sort of repo levels. And I think overall what they're showing is that we're still at ample reserves. Abundant reserves. We're still at abundant reserves, meaning above our goal of ample reserves, a little bit above ample reserves. So, but we're beginning to see, you're starting to see a little bit of tightening in money market conditions, particularly repo rates have moved up. And those are the things we're going to be watching. So we think we're still at abundant, and we're, the pace of runoff is now very, very slow. So we're going to be watching all those factors very carefully. And we're not so far away now, but there's a ways to go.
I think we're not going to get away without addressing this one. So I'll try to, again, group some of these together. First, there's definitely appreciation from the audience, your ability to try to remain above the political fray. And I think also, and as in your remarks, you said gradually and predictably, and that sounds really nice right about now. But with that ongoing scrutiny of the policy decisions of the Fed, what measures is the Federal Reserve taking, and are you taking, to ensure and demonstrate the continued independence in setting monetary policy?
So the main thing we can continue to do is to do our work the way we've always done it, which is, think really carefully about evolving economic conditions and the evolving outlook and the balance of risks, and try to make good decisions to best serve, the American public. And then explain those decisions and talk about them in a way that makes sense and is grounded in the data and our overall approach. I think we're going to keep doing that. And as long as we're doing that, people will be able to tell. If we start doing something else, I think people will be able to tell that too. But that's just not something we're ever going to do. We're always going to keep doing our work. We don't engage in back and forth with people. It's just not that gets to be political sort of right away. So we just do our work and do it as best we can. Overall, I would say the Fed comes through the last, if you think about it, go back to the beginning of the global financial crisis. We've had 2 world historical crises back to back, essentially. And the U.S. economy, it's been quite a ride for the U.S. economy and for American citizens, but we've come through it as well or better than any other country in the world. And we had to innovate and did innovate. There was really no choice. We can look back now and as I did today and second guess ourselves. which is only appropriate. That we've been doing it for 10 years. Since I got to the Fed 12 years ago, we were already doing a lot of that. So that's an ongoing process. But I think if you take a step back, the Fed is a government agency that does a good job for the public that it serves, and that is our only goal. And I think we do it pretty well. Don't look for perfection. You know, these are close calls that have to be made in real time.
No, you're not for the public.
But I guess that's what I would say.
It's fantastic. And in that context, then internally to the FOMC, how important is it that you have consensus on it? I mean, we're economists. We understand the value of spirited debate, and but is that important in terms of communicating the results and the decisions of the committee?
I mean, consensus is great, but I mean, the most important thing of all is to get it right. And, you know, that you come to places, not very commonly, but sometimes you come to places where people are going to have different views. And this is one of them. You have a situation here where literally inflation's above target and gently rising. The labor market is subject to pretty clear downside risks. What do you do? How do you think about that? That's not a problem that you face very often in central banking or in the economy. And people are going to have different weights and different risk aversion and different risk appetites on those things. It would be kind of surprising if you had no debate over those things. So we have a healthy debate going on. I think it's very healthy. I think the meetings that we've been having are as good as any we've had, you know, in terms of people sincerely, you know, giving their absolute best argument for their positions, but they're different positions. That's, I mean, when I was an investor, I always felt like the most dangerous thing is if everybody agreed on something, because you need someone to come in and try to explain why this is a terrible idea. Hopefully somebody really smart. And that would give you the ability to really test your thinking. So I think that's a healthy discussion that we're having right now. And I'm not at all surprised that we have people across the board. I do think we also, as an institution, do try to come together around you know, a central answer. And that's, of course, part of what I try to do is you know, find an answer that will attract as much support as possible.
Absolutely. I know you probably won't want to comment in great detail on global conditions, but there are a few questions around that and what that implies for U.S. monetary policy, and also just looking at the interest rate differentials between the U.S. and other advanced economies, and you know, how long that could persist, and is there a risk there?
Sorry,
the interest rate differentials between the U.S. and other advanced economies.
Yeah, I mean, you know, we set interest rates according to, you know, the place where our economy is domestically, you know, taking into account the international aspects of our economy. So again, it's not surprising. I mean, you could name many factors, but, you know, for example, tariffs are clearly more disinflationary for countries that are subjected to them, and they're more, I won't say heavily inflationary, but there's some inflationary pass through to consumers from countries that are putting tariffs on. So there's a very different monetary policy response potentially just in that. So, you know, I think we need to set, as every other central bank does, they're setting rates in whatever their, you know, remit is geographically, and they're going to be different answers. It's not unusual.
So we have a large number of young economists in the audience today. Could you talk a little bit about, as we look back, and, you know, it's a momentous award, it's a nice time to reflect. If you looked back on your early career and your early goals, how do you think that young Jerome?
All right. So, yeah, taking a look at the market reaction, I mean, essentially the whole point of this was to see if Jerome Powell would continue his stance on the current trajectory of, you know, cutting interest rates as inflation remains sticky, as well as growth, you know, remains pretty. It's not, you know, accelerating faster, but it is having a bit of a rebound and showing that it's being resilient, right? And so, if the Fed is cutting rates into that, then obviously a lot of these other companies are going to do, you know, pretty well with that increase in liquidity because of rates coming down, right? It's an easing of monetary policy. And so, yeah, I mean, it's no surprise that when the Fed is cutting rates, when things aren't, coming to an end, you're just going to get more steroids, more juice that goes into the system there. And so that's what we're seeing reflected in the markets currently. And so, what is interesting though is that when you take a look at what the bond market is signaling, you're getting a little bit of a different signal there. Specifically, taking a look at the 10-year bond yield versus the 2-year bond yield. This is signaling that the Fed is going to cut rates because either growth or inflation is slowing down. And so when we take a look at the 5-year break-even inflation rate over the past 2 days, that has had a clear breakdown, which we have not seen in quite some time, right? So I wouldn't be surprised if we do start to see inflation come down from here in a lot of the key metrics. And so, yeah, the context in which inflation continues to come down will matter if, what growth is doing at the same time, right? Because if inflation is coming down, but growth is actually, recovering, then that's a soft landing. If inflation is coming down because growth and the economy is slowing, well, that's a recessionary signal, right? So, I think that the bond market right now is signaling that inflation is going to come down, and it's more of a soft landing type of signal for the time being, which again, the market is enjoying that. And yeah, I mean, you also have to remember that hard landings start off as soft landings too. So who knows, maybe heading into mid 2026 or even, a year from now in 2026, that could be more of a recessionary signal. But I think, I don't think that there's any need for a panic in the markets, and that we're really just getting more of the same in terms of buying the dip in a lot of bullish assets. So yeah, I mean, I'd be looking for, starting to see hard data with inflation coming down from here, because that's what the bond market is signaling. And typically the bond market is the most important one to watch in terms of signals. Let's see what they're yapping about here.
Back to the balance sheet, some questions. Again, I'll kind of try to group these together around mortgage-backed securities and housing affordability. Again, not directly part of the dual mandate, but would the Fed ever look at any specific actions with regard to MBS to address mortgage rates or affordability for housing?
The answer is, look, we look at overall inflation and we don't target housing prices. And also I don't know how you would, we would certainly not engage in mortgage-backed security purchases as a way of addressing mortgage rates or housing directly. That's not what we do. We do have, as I mentioned, a very large amount of mortgage-backed securities, and they're running off, but they run off pretty slowly. So.
Fair. Question on the beverage curve. Maybe that's not a lightning round question, but let's try it. So do you think that the shift in the beverage curve is a structural shift or just a blip?
I think it's, you're at a place where, further declines in job openings might very well start to show up in unemployment. You've had this amazing time where you came straight down, but I just think you're going to reach a point at which unemployment starts to go up, and we haven't really. We may be hitting that now, but it's been remarkable how that line had just comes down, and which has been really a great part of the recovery.
All right. Well, we have just a couple minutes left. I think we'll end with maybe another sort of philosophical question. Michael Barr spoke to the policy conference in 2024, I believe it was, and he gave some advice to economists. What would your advice be to the economists in the room in terms of how we can best serve the challenges that are facing us collectively in this moment?
I'm inclined to say keep your heads up. It's a time when people are challenging expertise, and I think it's a distinguished profession. It's a very high order profession, and you should be proud of your work and keep at it. Ultimately, we're learning about how the economy works and how society works, our understanding is so basic and so uncertain, really, still after all these years. But, you got to think we're making some progress and doing some good, and imposing sort of an analytical framework around the kind of decisions people make about the economy. So I just want to give you a vote of support and say, keep at it.
And likewise, NABE supports you.
Are we done?
We're done. Thank you so much.
Thank you. Thank you. Thank you.
He wanted to get out of there so fast. Are we done here? Oh, man. Yeah, he did not want to do that. But all right, well, these types of things, he has to do them, and he typically repeats more of the same. Pretty much the purpose of even watching those things is to really try and get a sense if his outlook has changed at all, given the recent developments. And it sounds like there isn't really any change from what they're seeing. And yeah, I think we're going to continue to get rate cuts as we're going to continue to get rate cuts as a soft landing narrative is going to continue throughout the markets here. And so I really don't see any type of bear markets, circulating its way through. And a lot of at some point that will happen, right? But there's no point in trying to predict when or what magnitude that will happen, because if you try and do that, you're ultimately going to miss out on a big rally. So, I think that's what the takeaway is from here, is that it's gonna be party on. Now, there has been some structural shifts, right? We've seen this breakdown in the 5-year break-even inflation rate, while at the same time the dollar is bullish. And then we also just saw a huge spike in credit spreads recently. And so, looking at these at the same time, this is definitely something that we have not seen before, over the past, pretty much since the middle of April. So it's definitely a time to not just like blindly throw money in our view, right? We can't give direct financial advice, but in terms of our process goes, especially with the way that we just saw a pretty decent spike in the volatility index of the S&P 500. As of right now, this is a great spot to essentially whatever broke trend in your portfolio, right? Just, our team is getting rid of those. And we are doubling down on the trends that are continuing to do the best. Gold miners, silver miners, silver, gold, any type of precious metals / base metals. Let's see here. Uranium. Looks like coffee just had a big breakout. Palladium, platinum. Look at these things. You can go to places that aren't just, stocks and crypto. There's plenty of other bull markets that are, continuing to rip higher. In terms of Bitcoin, like I mentioned earlier in the show, I'd probably just want to wait for this to tell us which direction it wants to go in, because these wild swings, risk adjusted, I think there's better places to put your money, right, for the time being, until Bitcoin decides, which way it wants to go. So yeah, that, as well as, you're starting to see some strength come back within stablecoin dominance. Altcoin dominance just had a huge drop off. Let's see. DeFi dominance just had a huge drop off and is now in bearish trend. Bitcoin dominance. Let me see where Bitcoin dominance is. Bitcoin dominance is starting to gain strength. So you're not really seeing a risk on type of environment within the crypto space. And so I would just be cautious for those who are thinking like, hey, let's just buy the dips in these things. AVAX, XRP, Solana all went bearish on our model, so you can take that for what it's worth. But for us personally, when something is in a bearish trend, we are not buyers of those things, right? Let the trend confirm itself, and then find positions in order to get in. Because again, the whole point of our process is you want to be invested into something as it makes its long-term up move, and not try and time tops and bottoms perfectly, because no one can really do that, and you're just going to set yourself up for long-term failure if you try and do that. With that being said, though, there's still bullish trends in the Russell 2000 small caps with IWM. There was a pretty decent buying opportunity there this morning. Same thing with Qs as well as the S&P 500, all of which still remain in bullish trend. Out of the top 10 stocks, Walmart is having a huge breakout right now, along with Google. So yeah, I think Google also is going to have a large breakout here. I was buying some of that over the past couple days, and looks like it's having a little bit of a bull flag here. So wouldn't be surprised if we get a further acceleration into Google. Might buy some more NVIDIA today. I was buying some JP Morgan this morning. Amazon I'm not buying because it's neutral. But yeah, that's pretty much what I'm seeing. That doesn't mean that there's going to be that doesn't mean that there's not any type of risks moving forward, right? Because in that speech by Powell, he was talking about ample versus abundant reserves, and they think that they have ample reserves, but they're going to continue to try and reduce those downward, right? So when taking a look at net central bank liquidity, it has had a large drop off, right? Because you had a pretty decent acceleration from the end of September in October of last year in 2024 to it peaking around April of this year, and then ever since then it's kind of been on a drag, right? And it's at levels that it's pretty much been at since the beginning of 2024. And I pulled up this chart momentarily, but what's interesting is that if you bring up a chart of Bitcoin and overlay this, and then let's put Bitcoin on logarithmic, you can pretty much see how Bitcoin's price action with net central bank reserves has a positive correlation, right? Now, there are times where it's not as positive, but zooming out and seeing a general trend, you can see that both the net central bank liquidity metric in red and Bitcoin pretty much go hand in hand. And so as of right now of the recording of this video, we saw a huge gap between these two metrics ever since August or the beginning of September of this year. And so, I wouldn't be surprised if, well, actually, if you're someone who's heavily invested in Bitcoin, you would want to see net central bank liquidity rise from here, which it very much could. But you're not going to be getting an increase in liquidity from a depletion of the RRP, because that's pretty much at zero right now. You could see the TGA balance go down, but with the amount of government printing that's going on from the amount of debt that they're issuing, they need the cash reserves there. And so I don't think you're going to get it from there. And then lastly, you would need to see reserves have a bounce back, which, the Fed has guided that they're going to try and, decrease this as much as they can. And so I don't really see a huge increase in net central bank liquidity from here, which could be some further headwinds on the price of Bitcoin. So yeah, I mean, when it comes to the crypto space, I don't know, when it comes to the crypto space, I see some further downside from here. But yeah, I saw someone just comment that they're getting cooked in crypto. Yeah, I mean, there's a lot of signs to consolidate. A lot of our altcoins have been telling us that they went from bullish to neutral trend over the past couple months. So if you're not getting those insights for crypto, and you're just kind of winging it essentially, I would highly recommend that you try and look for some type of place in order to start your macro journey, because for those crypto investors who are incorporating macroeconomics into their process, those are the ones that are doing the best right now, right? So, yeah, that's what I am looking at right now. What was the coffee symbol? That was just the coffee futures. Let's see. KC1. I know that there used to be Joe for a good coffee ETF. Let's see. Let's see if it doesn't really look like there's a ETF for coffee at the moment for the United States. Looks like there is one for COFF, but let me see what. Where is this based out of? Okay, London Stock Exchange. So if you do have access to London markets, COFF is the ETF that you could use there. I don't know why they don't have that for the United States. That's strange. But all right, ladies and gentlemen, I do have to get to my next meeting here at 1:30. I appreciate everyone for joining. As I mentioned at the beginning, if you guys want to gain access to all of our resources and processes, as well as which assets we're looking at and which assets we are completely avoiding based off of our macro process, we did open up our partnership circle for a 6-week challenge that we're hosting from now until the end of the year, where you can essentially gain access to all of our resources and start your macro investing journey, adding those skills to your current process to make you better, making sure that you're better at timing, owning things that continue to go up instead of bag holding things that go down. You can start that process by going to the link below, and first by booking a strategy session with myself where we can just review it and you can see everything from there. But appreciate everyone for joining. We're going to go ahead and end it there. We will catch you in tomorrow's daily macro update. Bye.